Stock and Bond Basics. Hi, this is Ken Boyd with the Accounting Accidentally website, and also this video is part of an extended series I'm doing for Accounting Ed on understanding mutual funds. So I'd like to go over a portion of this document on stock and bond basics. This is a basic building block for what you need to know for investing in mutual funds, because most mutual funds invest in stocks and bonds, the vast majority. I'll get to all the things they invest in later, but we need to know stocks and bonds as a starting point. So there's two ways a company can raise capital. The investment community has become very complicated, but it really boils down to two basic ways. So let's define what capital is. Capital is money raised by a business to purchase assets, things you need to run the business, equipment and machinery, and also to operate the business, to pay salaries, buy inventory. And the two basic ways a company can raise money is to issue stock or bonds. Stock means equity. The investor is an owner in the business. Debt, on the other hand, bonds, means that the investor is a creditor, just like any other lender is a creditor. And there are benefits to both of these groups. You'll see three benefits on the left which apply to shareholders, and two on the right which apply to bondholders. If you're a stock investor, you may benefit from earning a dividend, which is a payout of a share of the company's earnings. And this is conditional. If a dividend is declared by the board of directors and they can choose to pay any dollar amount of dividend or no dividend at all, and if the company doesn't have any earnings at all, you don't get a dividend. Many startup companies that have inconsistent earnings or no earnings for a while don't pay a dividend. As an example, Microsoft didn't pay a dividend for a long time as a public company because people benefited from the stock price increase. And that's the next bullet point. You can benefit from an increase in the stock price if the company performs well and grows sales and has increasing earnings. The share price may increase because investors buy the stock, and you can sell your stock for a gain and benefit that way. The final benefit I list for being a stockholder, a shareholder, is voting rights. You get to vote on major corporate decisions, like if the company sells itself, whether or not the company should merge with another company, and you get to vote on board members. Those are benefits from owning stock. Bonds, on the other hand, are the right-hand bullet points. If you're a bondholder, you can earn interest income, and typically corporations pay interest income semi-annually, twice a year, to a bondholder. And your bond can increase in price. Now, most of a bond price increase is due to a decline in interest rates. If you have a 6% IBM corporate bond and interest rates decline, that 6% will be more attractive than current rates to investors, and they may buy the bond to earn the higher current interest rate given the bond's credit rating. So a bond with a high credit rating, interest rates fall, the price of the bond will go up. You could potentially sell the bond for a gain. So that's what I wanted to talk about on stock and bond basics. And again, this is part of a larger course I'm doing for Accounting Ed. Remember that you can find on the Accounting Accidentally website over 100 blog posts, links to this YouTube channel grouped by topic, and also my extensive list of courses on the Accounting Ed website. Thanks for watching, and we'll see you next time.